$20,000 isn't enough to buy a house, but it's more than enough to start owning real estate. And the way people are doing it in 2026 has nothing to do with mortgages, credit checks, or property managers calling you at midnight about a broken water heater. By the end of this video, you'll know exactly where that $20,000 can go: 3 real paths, real minimums, real numbers, and which one actually fits how much risk you're willing to take. Let's get into it. Section 1. Why real estate? Why now? Real estate has built more American wealth than almost any other asset class. Not because it makes people rich overnight, it doesn't, but because it does 2 things stocks alone don't always do. It pays you cash while you hold it, and it tends to hold its value when inflation rises. That's exactly why more people are looking at real estate right now. Mortgage rates have been moving, rents have stayed strong in most major metros, and a lot of investors are tired of watching their cash lose value sitting in a bank account. The problem has always been the entry point. A down payment alone can eat your entire $20,000 before you even think about closing costs, inspections, or repairs. So here's what's actually available to you right now. Section 2, Option 1, REIT ETFs. The simplest way in is a real estate investment trust, or REIT, through a regular brokerage account. A REIT is a company that owns income-producing property, apartment buildings, warehouses, data centers, shopping centers, and by law, it has to pay out at least 90% of its taxable income to shareholders as dividends. You don't need $20,000 to start. You could buy a REIT ETF like the Vanguard Real Estate ETF, ticker VNQ, for the price of 1 share, which has traded in the low to mid $80 range through 2025 and 2026. Put in $5,000, $10,000, or the full 20. It's completely flexible. The upside, it's liquid. You can sell any day the market is open. Unlike owning an actual house. The downside, it moves with the stock market more than people expect. So during a market downturn, your REIT ETF can drop right alongside your other stocks, even though the underlying property is fine. Section 3, Option 2, Real Estate Crowdfunding. The second path is real estate crowdfunding, and this is where platforms like Fundrise come in. Fundrise pools money from thousands of investors and uses it to buy actual properties, apartment complexes, single-family rental portfolios, industrial buildings, then pays investors a share of the rental income and any appreciation when properties are sold. The minimum to start is around $10. But if you're putting real money to work, most investors allocate a meaningful chunk, for example, $5,000 to $15,000, into one of their diversified portfolios. The historical returns Fundrise has published have generally landed in the mid-single digits to low double digits annually, depending on the year and the fund. That's not guaranteed, and it's lower than the stock market in some years, higher in others. Here's the trade-off you need to understand. This is not liquid like a stock. Your money is typically locked in, and if you want to withdraw early, there are redemption windows and sometimes penalty periods. This is money you should be comfortable not touching for at least 3 to 5 years. Section 4, Option 3, Fractional Single-Family Homes. The third option is newer, and it's specifically for people who want to own a piece of an actual house, not just a fund. Platforms like Arrived let you buy shares in individual single-family rental homes, starting around $100 per share. With $20,000, you could spread that across multiple properties in different cities, say, $5,000 in a rental in Ohio, $5,000 in Georgia, and so on, collecting a portion of the rent and a portion of any appreciation when the home eventually sells. This gives you something the other 2 options don't. You can actually choose the property. You see the address, the neighborhood, the projected rent. For people who like real estate specifically because they understand houses and neighborhoods, this scratches that itch without needing a mortgage. The risk here is concentration and vacancy. If that specific home sits empty for 2 months, or needs a new roof, that affects your return directly, because you're not spread across hundreds of properties like you are in a REIT ETF. Section 5. How to actually split $20,000. If someone asked me how to actually divide $20,000 across these 3, here's a framework based on risk tolerance, not a guarantee of returns. A more conservative investor might put $12,000 into a REIT ETF for liquidity, $6,000 into a crowdfunding platform for higher income potential, and $2,000 into fractional homes just to learn how it works. A more aggressive investor, comfortable locking up money longer, might flip that, more into crowdfunding and fractional properties, less into the ETF. There's no perfect split. What matters is knowing exactly how liquid each dollar is before you commit it, because pulling money out early from crowdfunding or fractional platforms can cost you in fees, or force you to sell at a bad time. Section 6. The risks nobody skips mentioning. Every one of these options carries real risk. REIT ETFs can drop 15–20% in a bad year for real estate stocks. Crowdfunding platforms are not FDIC insured. If the fund underperforms or a property loses value, you can lose principal. Fractional home platforms depend on rental demand in that specific market. If a local economy weakens, so does your return. This isn't a guaranteed income strategy. It's a long-term wealth-building tool, and it works best when you treat it that way. Money you're not going to need in the next 12 months. $20,000 won't buy you a house in 2026, but split the right way, across a REIT ETF, a crowdfunding platform, and fractional home ownership, it can start putting real estate income into your pocket without a single mortgage application. The people building wealth this way aren't the ones chasing the highest return. They're the ones who understood the trade-offs before they invested a single dollar. If this helped you think about your own $20,000 differently, subscribe, because next week we're breaking down exactly how much rental income these platforms actually paid out last year, with real numbers.